because we wanted this to be educational, and this is going to be a additional portion to the content that we're creating for our private monthly members, teaching them DeFi, showing them our portfolios, myself and Mr. Aquaman, growing six-figure portfolios in DeFi outside of our long-term bags, outside of our trading activity, just making passive income in the space. Let's dive in and talk about on one of the benefits, first of all, being a liquidity provider, right? You got 3 different portfolios, in my personal opinion, you should be aiming to build. 3 skills you should be attempting to acquire in the digital asset ecosystem in these early stages. It's 1, obviously, of course, mastering being a long-term hodler. All the things that come in tandem with that. Having access to multiple centralized exchanges, multiple OTC brokers, having multiple cold storage wallets, being fluent with moving money, moving crypto in and out in the form of fiat, through your wallets, through your exchanges, this and that. That's a skill that you're going to have to master. It's not easy. It's not an easy feat to do that. It takes a learning curve. And then obviously, of course, practicing safety and soundness. And then also being a day trader, utilizing and understanding how to master leverage, how to master these charts, how to master intraday trades and fundamentals and technical analysis to scale your wealth, to grow your wealth, to grow your income. Obviously, of course, that's a little bit more of a risky task and requires a lot more hands-on activity. And then you have being a liquidity provider or involving yourself in staking or lending platforms to grow your wealth passively in the digital asset space. And that's what we're focused on in today's video breakdown. And that is and requires a lot less hands-on activity than trading, but a little bit more hands-on activity than just hodling. Right. So it's kind of like being a liquidity provider for me is kind of like in the middle. It's that good medium of you're a little bit more hands-on. You're making a lot more money than just being a hodler. Facts. You're making a lot less money than being a trader that uses leverage, but it's that sweet spot in between that allows you to grow passive income, still requires a little bit of hands-on activity, especially if you're in concentrated ranges. And I'll go over that in just one second, but still gives you the ability to grow and scale your wealth seamlessly, right? Without really any effort comparative to if you were to try to make passive income the traditional route, right? Real estate is a big traditional way of investing to make passive income. Think about the headache that getting involved in real estate comes with: getting in debt, getting a loan for the properties and whatnot, then actually having to find tenants that are reliable, that will actually rent out your property, that'll pay the mortgage plus some, so you can make the passive income every single month. It's all a headache, all the paperwork, all the physical, tangible attachments to real estate to make that passive income. You could be doing the same thing, making passive income by being a liquidity provider in DeFi and make way more passive income off of a less investment, if that makes sense.
No, 100%. 100%. You made perfect sense, brother. So, yeah.
But yeah, just kind of going over ranges. So since we're on the topic of concentrated liquidity pools, concentrated ranges, Mr. Aquaman covered what happens if you go out of range. So just as an example, this is my current range on SUI USDC. Now, if this price action goes out of the range to the downside, I would stop earning fees. Same thing, if the price action goes out of range to the upside, I would stop making fees, right? On the liquidity that I'm providing for this tight range. It's not a bad thing, but as liquidity providers, we want to constantly be earning fees. So with that being said, this is why understanding technical analysis and understanding fundamentals and how price action could potentially react in the near and short-term future is imperative if you're going to be a liquidity provider. It's not necessarily mandatory because there are ways around it, especially if you just want to enter into wide range liquidity pools where you're providing liquidity for the whole entire area of price action on the higher time frame. But if you're not, and you want a more concentrated range that provides you higher APRs, you're going to need to know this stuff. So today, as you all know, we have the federal funds rate, which was just announced. They pretty much kept the rate the same. Dollar index dropped right on the initial announcement. So you can see a slight pullback via the most recent strength in the dollar that we've seen. But the reason why it's important to pay attention to this stuff is because if my range changes based off of these fundamentals, which we'll go over in just one second, I will need to adjust my position. All right. So that's why it's a little bit more hands-on when you're in concentrated ranges, but still a lot less hands-on than if you were to be an active day trader, right? You're really only managing your positions maybe checking them once a day, once a week, maybe every 2 weeks, so on and so forth, depending on what time frame you're providing your ranges on. But it's still important to understand this stuff. So today, let's just take a look at the fundamentals real fast, because we have obviously, of course, we just had the federal funds rate where they kept rates the same. That was obviously, of course, predicted. We knew most likely because of the uptick in inflation that we've seen over the past consecutive couple of months since pretty much the middle of March, weighing on risk assets, we knew that the Federal Reserve was not going to cut rates. Okay. The projection at the beginning of this year was that the Federal Reserve was going to cut rates in this time frame that we're currently in, which clearly wasn't happening. Inflation's not coming down to the Fed's goal of 2% to meet their mandate. It's showing signs of being a little bit troublesome, being a little bit sticky, right? Kind of fluctuating, not really coming down to the Fed's goal. And so they're in no position right now, as of time of recording this video, to cut rates. So our next focus is going to be on Jerome Powell's speech and how that's going to impact the market. So I have some pictures for you to kind of talk through what the potential outcome of Jerome Powell's comments on the overall economy and interest rate policy could potentially be, and how that could affect the market, and why it's important to know this in case you are in a concentrated liquidity pool and you need to adjust your ranges, right? So a bullish scenario, we'll go over that one first because that's the one that everybody would most likely want, right? As risk asset investors, we would like to see our assets appreciate in value. And so in order for that to happen, as of right now, obviously, of course, we know over the past consecutive couple of weeks, we've seen an uptick in inflation. We've seen healthy data on the US front, i.e. signaling strength and resilience in the US economy. And we've also had geopolitical tensions and escalations in the Middle East drive more of a demand for the safe haven status of the dollar, which is why all three of those factors, we are seeing a stronger dollar and have seen a stronger dollar over the past consecutive couple of weeks. That's why risk assets across the board, including Bitcoin, have seen a depreciation in value comparative to the end of 2023 and the beginning of this year, where we saw bullish momentum. We saw bullish momentum at the end of the year 2023 and the beginning of the year 2024 because we saw a slight decline in inflation. We saw downbeat US data, weakening the strength of the US dollar, and we saw no real further escalations in tensions in the Middle East and Russia and Ukraine and so on and so forth, right? That all changed in the middle of March and leads us to where we're currently at now. So let's just go over the bullish scenario because we have some comments from Jerome Powell coming out in a second. I don't think that this call will last long enough to go over those. We'll see. But the more favorable environment for us to see price appreciation on our digital assets, i.e. us potentially heading back to the top of this range and me needing to adjust my range to potentially engulf the entirety of this price action, or potentially even moving it above this intraday high here, would be if we saw comments from Jerome Powell that hold a more dovish tone, where he says things like he still sees inflation coming down this year, remaining optimistic on the fight on inflation, where he potentially discusses the possibility of 2 to 3 rate cuts happening this year and projects those timelines. He solidifies that he sees rate cuts happening in said month, and also mentions the possibility of a soft landing and supports the rate cut hopes. A scenario like that would most likely continue to weigh on the dollar via the most recent pullback that we've just seen, potentially breaking back below this previous bullish structure and correcting more of this previous bullish move. And on our risk assets, that would most likely lead to a bullish scenario where over the past consecutive couple of weeks, we've seen a downturn in the digital asset space. If we see dovish comments with these supporting fundamental factors, we would most likely see a reversal of that most recent bearish sentiment, right? We would most likely see strength in risk assets. So with that being said, understanding these fundamentals is important because if we get that data today, I will know as a concentrated liquidity provider that I will need to extend my range to the upside. Why? Because the most likely scenario, given these comments and given how the market's going to react to that, will most likely be buy pressure or bullish order flow in the digital asset ecosystem. Is everybody kind of tracking that? Why it's important to understand that? Remember, I'm not day trading. I'm not sitting here taking long positions on a leveraged account on SUI US dollar or USDC. But it's important to know this stuff if the market sees an uptick in price, where I'm going to need to move my ranges based off of technical analysis and fundamentals. So that way I'm still operating in a concentrated range, making the most APR that I possibly can on the deposit for this liquidity pool. Inversely, right? Why is it important to know what could potentially happen to be the opposite? And that would be the hawkish comments that we could potentially see from Jerome Powell. Again, I'm not monitoring this live, about 16 minutes into the FOMC release. So he could be talking soon. Probably in the next couple of minutes, we're going to start to see some commentary via the live feed that I have here from Reuters. Okay. But hawkish comments, we need to understand what that would lead to. That would lead to more depreciation in risk assets and more dollar strength. So if we saw Jerome Powell comment things like, or make comments like mentioning that inflation is still sticky and troublesome, that the fight on inflation is nowhere near done, that they're going to need to keep interest rates higher for longer to tame inflation, or potentially even consider hiking rates if need be. That would be insane, right? I don't think that that's going to happen, but it's a possibility. And then him pushing back rate cuts or signaling to the market comments that could potentially lead to less or no rate cuts this year. Because remember, the market as of right now is projecting 2 to 1 rate cut this year as of right now. Beginning of the year, the market was expecting 7 to 4, right? If that number continues to dwindle and Jerome Powell says, look, we're in no position to cut rates this year. I don't even see, because remember in his last FOMC meeting in March, he said he sees 3 rate cuts. If he reverses that and says, I don't even see 1 rate cut anymore this year, right? That's going to weigh on risk assets, prop up the dollar. And so we're going to need to react to that information and adjust our ranges. Why? Because we know that we're most likely going to continue this downwards momentum that we've most recently seen due to these fundamental factors, due to an uptick in inflation, due to stronger US data, due to geopolitical escalations. 3 factors, all of those things driving demand for the dollar. We know that hawkish comments would most likely lead to a further demand in the dollar and way further on risk assets. So then we could potentially start to look at areas of interest here for price to come down into, and then we would need to adjust our range to the downside, right? We would need to potentially move the bottom of the range underneath of this demand range, especially if we're expecting further depreciation in risk assets, right? So that's why it's important to understand these fundamentals so that way you can stay in range as a concentrated liquidity provider to get the best APR. Again, maturing in your investing and trading career to really understand how to scale and grow your wealth. It's not hard to understand these things. Yes, it takes some time. Yes, it takes some elbow grease, but this is nothing like trading and is a lot more laid back. You're not sitting here and placing long positions or leveraging any money. You're just being a liquidity provider and understanding how to adjust your ranges based off of fundamentals, based off of technical analysis, and we can get so much more in depth. But hopefully this gives you a general perspective of why it's important to understand fundamentals, how to react to them, so that way you can adjust your ranges, i.e. your concentrated liquidity pool.